Hey everyone, it's Nick from Sure Dividend here, and in today's video we're going to be discussing the performance of every Dividend Aristocrat during the Great Recession. So before we begin, I thought we could just talk about a brief overview of what the Dividend Aristocrats are and why we've decided to talk about their recession performance today. So the Dividend Aristocrats are a group of dividend stocks that have three requirements. The first is membership in the S&P 500. So in order to be a Dividend Aristocrat, you have to be in the S&P 500. The second requirement, and the most important requirement, is to have 25 years of consecutive dividend increases. And that's really powerful because if you think about it, it takes a strong and durable competitive advantage to increase the dividend every year for 25 years. The third requirement is to meet certain minimum size and liquidity requirements. There are some companies that meet the dividend history requirement to be a Dividend Aristocrat, but they're so small and illiquid that they're excluded from this exclusive group of dividend stocks. Now, right now, there's 50 Dividend Aristocrats, and we view them as some of the most recession-resistant stocks around because they've increased their dividend for more than 2 decades, which involves many business cycles and shows that they have the ability to prosper through all economic environments. Now, we actually maintain a list of all the Dividend Aristocrats, including important investing metrics like price-to-earnings ratios and dividend yields. And you can access that database in the description of our video. So I'm going to go through one by one now and show you, for every Dividend Aristocrat, how their earnings performed and how their stock price performed. And then at the end of the video, I'll show you a ranking of the 10 best Dividend Aristocrats to own when recessions come. The first Dividend Aristocrat, and we're going in alphabetical order here based on their ticker, not based on their name. So the first Dividend Aristocrat, sorting that way, is AbbVie. And AbbVie is a biopharmaceutical company known for its flagship drug Humira. Humira is the highest grossing drug for AbbVie, and it's also the highest grossing drug in the world. Now, AbbVie is a healthcare company, so you would think that they would perform quite well in a recession. But it was only spun off from Abbot Laboratories in early 2013. So we actually don't have any data on how it would perform during a recession. Now, with that said, we can kind of guesstimate how AbbVie would perform during a recession by looking at its parent company's performance. And fortunately, that's actually the next company in the Dividend Aristocrats list, Abbott Labs. Now, Abbott Laboratories is a global pharmaceutical company with a market cap of about $102 billion, and they've increased their dividend for 45 consecutive years. Now, 45 consecutive years is well past the minimum requirement to be a Dividend Aristocrat, and Abbott's a healthcare company, so those two things combined together suggest that Abbott would perform reasonably well during a recession, and that's exactly what the data shows. If you look at Abbott's earnings, during the 3 years that the global financial crisis occurred, it actually increased each and every year. So in 2008, they recorded a 7% gain. In 2009, it rose 23%. And in 2010, earnings were up 12%. Now that's amazing performance because a lot of companies saw their earnings decline by more than a factor of 2. So Abbott, on the bottom line, looks to be very recession resistant. Now their stock price tells the same story. During a time period where a lot of equities dropped by more than 50%, Abbott kind of slowly just stagnated along within a narrow trading band. And if you were to buy Abbott at the worst time and sell it at the worst time, so buy it at its highest point and sell it at its lowest point, you would have actually recorded a 31% loss. Now that number, in my opinion, is actually a little bit artificial because I think it's very rare for someone to buy at the worst time and sell at the worst time. You might do one or the other, but the probability that you do both is actually very low. So with that said, we're going to use the same methodology to assess the recession performance of every stock in the Dividend Aristocrats throughout the rest of this video. Next up among the Dividend Aristocrats, we have Archer Daniels Midland. Now, ADM is one of the biggest agricultural companies in the world. They have a market capitalization of about $23 billion, and they've increased their dividend for 35 years in a row. Now, this is impressive for any company, but the agricultural industry is notoriously cyclical. So that makes Archer Daniels Midland's dividend history even more impressive. Now let's see how their bottom line performed during the Great Recession. As you can see, ADM saw no year of significant earnings decline during the recession. In 2008, their earnings increased by 19%. In 2009, their earnings increased by 8%. And in 2010, their earnings remained relatively flat. I think they may have actually declined by a penny. Now, unfortunately, their stock price did not tell the same story. They actually recorded a pretty significant loss from peak to trough. And if you were to buy ADM at the worst point during the Great Recession and sell at the worst point, you would have recorded a loss of nearly 70% or 68%. Now, I find this very interesting because as we saw with the company's fundamental performance, it was actually quite good. I think the reason why its stock declined so significantly is that ADM is known to be a cyclical stock. The company's performance isn't cyclical with respect to the business cycle. It's cyclical with respect to commodity prices. If commodity prices drop, so does the company's performance. But ADM's performance doesn't necessarily decline just because equity markets are going down or overall economic activity slows. I think that the stock was categorized as a cyclical stock, and the markets punished it accordingly during the global financial crisis. The next stock in the Dividend Aristocrats list is Automatic Data Processing, and this is a business services outsourcing company that's most well known for doing payroll services for small and large businesses. ADP has a market capitalization of about $54 billion, so they're quite a large company, and they also have 43 years of consecutive dividend increases. Let's take a look at how their earnings performed during the recession. So far, they're following the same trend as all these other businesses. Their earnings have remained rising or stable during every year of the financial crisis. In 2008, they recorded a 20% gain. In 2009, they recorded a 9% gain. And in 2010, their earnings were flat year on year. The company's stock price also performed reasonably well. As you can see in the chart on the screen right now, ADP's stock price stagnated in a narrow range throughout the Great Recession, and there was no significant decline as we saw with ADM. If you were to buy ADP at the worst time and sell it at the worst time during the Great Recession, your loss would have only been 38%, which is actually quite good in comparison to many other equities. The next aristocrat that we'll look at is Aflac, which is a US and Japan-focused insurance company with a market capitalization of $34 billion. Aflac's increased its dividend for 34 years in a row, which shows that it can withstand most market cycles and continue to prosper regardless of what the overall economy is doing. Unfortunately, though, the company did report a pretty significant 20% decline in earnings during 2008. And I think that that's largely due to the company's investment portfolio. So the way insurance companies work is they take money in and they hold it until they have to pay out claims. Meanwhile, they'll invest that money in equities, fixed income, and other investments. I think that Aflac's insurance performance probably remained quite stable during the recession, but it was their investment portfolio that caused the 20% decline in earnings that you can see in 2008. The company's stock price also performed terribly, especially when compared to many of the other dividend aristocrats. If you were to buy Aflac at the worst time and sell it at the worst time, your peak to trough decline would have been a remarkable 83%. Now that's not just bad compared to the other dividend aristocrats, but that's bad compared to many other equities outside of the dividend aristocrats too. Accordingly, I wouldn't say that Aflac is a very defensive position for your investment portfolio. The next company we'll talk about is Air Products and Chemicals. Now this is a business-to-business manufacturer of atmospheric and processed gases with a market cap of about $37 billion. Air Products and Chemicals has 35 years of consecutive dividend increases. Now this slide shows the company's fundamental performance during the Great Recession. As you can see, 2008 was a good year. Earnings were up 13%. But then in 2009, they lost all of this gain, declining by 18%, before recording a 24% gain and roughly equaling their pre-crisis high. Now their stock price didn't perform quite so well. As you can see, the company's stock price dropped precipitously after the summer of 2008. If you were to buy this stock at the worst time and also sell it at the worst time, your peak to trough decline would be about 61%. So your APD stock would have lost more than half its value, even though the underlying business actually performed reasonably well. The next stock we'll look at is Becton Dickinson. And Becton Dickinson is a large medical supply company with a market capitalization of $54 billion. Becton Dickinson is one of the longest dividend histories of any dividend aristocrat. The company has 46 years of consecutive dividend increases. Now, being in the healthcare industry, it's not that surprising that Becton Dickinson has actually performed really well during past recessions. As you can see on the screen, the company's earnings were up 16% in 2008 and 11% in 2009, before roughly flatlining in 2010. The company's stock also performed reasonably well. Though it did experience a minor decline in late 2008 and early 2009, it performed way better than many other publicly traded equities. If you were to buy Becton Dickinson at the worst time and also sell it at its lowest point, your peak to trough decline would have only been 35%, which is quite good. The next company we'll look at is Franklin Resources. This is an asset management and mutual fund company that operates through the brand name Franklin Templeton Investments, whose logo you can see on the screen. The company has a market capitalization of $25 billion and has increased its dividend for 36 years in a row. Franklin Templeton's earnings were crushed in the Great Recession by 42%. Now, there's two reasons for this. The first is that in the Great Recession, equity prices declined precipitously, and Franklin Resources generates most of its revenue from asset-based mutual fund fees. So when assets decline, their revenue also declines. Now, the other factor is that many equity investors were scared out of the markets and withdrew funds as prices declined. This has the effect of further reducing the company's assets under management, which reduced their revenues and, by association, their earnings. Their stock price performed even worse. As you can see, Franklin Resources stock started to decline in about late 2007 and lost roughly more than half of its value. If you were to buy it at its high point and sell it at its low point, your peak to trough decline would have been 73%, wiping out a significant amount of your shareholder value. Accordingly, Franklin Resources and other asset managers, they're not good stocks to own if you expect a recession is around the corner. The next company we'll look at is Brown-Forman. Now, this is an alcoholic beverage manufacturer that's most well known for its signature Jack Daniel's whiskey. Brown-Forman has increased its dividend for 33 years in a row. And based on the addictive nature of alcohol, it performed really well during the recession. This may unfortunately be because people decided to drink away their economic problems, but it is quite remarkable that Brown-Forman's earnings increased by 1%, followed by a 7% rise, followed by a 16% rise. Their stock didn't perform quite as well. As you can see, Brown-Forman's stock price really dropped off a cliff in late 2008. Buying at their high point and selling at their low point would have resulted in a loss of 53%, which wipes out slightly more than half of your value, a loss that's really hard to come back from in the markets. Because of the company's strong fundamental performance and weak stock price performance, Brown-Forman would actually be a good stock to buy if a recession did occur, because you're going to be buying it at a really low valuation multiple, allowing you to capture value when the markets are in distress. The next stock we'll talk about is Cardinal Health. And this company is a business-to-business pharmaceutical distributor with a market cap of about $23 billion. Cardinal Health also has 32 years of dividend increases. Now, before we turn over to look at their recession performance, it's worth noting that Cardinal Health executed a really significant spin-off in 2008, right when the recession was occurring. So it looks like on the surface that their earnings declined, but in reality, this was simply because they offloaded one of their business units. If you look at their segment performance, each of Cardinal Health's operating segments experienced rising earnings and dividends and revenues during the Great Recession. So keep that in mind as we look at the data. Now here's the data I spoke about earlier. It looks like Cardinal Health's earnings declined by 41% during the financial crisis, but this is due to the spinoff of that business, which was called CareFusion. The company's stock price also declined as investors in Cardinal Health were rewarded by new CareFusion shares, and the price of Cardinal Health dropped in a proportionate amount. The peak to trough decline here, mathematically, is 67%. But as I've indicated, this isn't indicative of the company's fundamental performance during this time period. The next company we'll look at is Cincinnati Financial Corporation. This is a large insurance company with a market capitalization of $12 billion. Cincinnati Financial has increased its dividend for 57 years in a row, which also makes it a Dividend King. For those of you that are unfamiliar with the Dividend Kings, these are companies that have increased their dividend for not just 25 years, but for 50 years. This is twice the requirement to be a Dividend Aristocrat. Dividend Kings are arguably even more recession resilient than Dividend Aristocrats. And I'll toss a link to the Dividend Kings database in the description of this video so that you can look through the Dividend Kings list. What really stands out about Cincinnati Financial versus other insurance companies is that the company allocates a portion of its investment portfolios to equities. And that's quite rare because most insurers, they focus on bonds or fixed income instruments due to the risk-averse nature of their business model. Cincinnati Financial has this unique ability to think long-term and accordingly allocate a portion of its investments towards equities, which boosts long-term total returns. What that also does, though, is it worsens the company's recession performance. Cincinnati Financial's earnings declined by 41%, followed by a 37% decline in 2009. Earnings rebounded by 27% in the following year, but still were nowhere near where they were prior to the recession. Now, I bet you can imagine what happened to their stock price. Cincinnati Financial stock lost most of its value, and investors who bought at the top and sold at the bottom saw a 62% decline in their portfolio holdings. Cincinnati Financial is a well-run institution in general, but we wouldn't recommend buying them if downside protection is your primary concern. The equity allocation within their investment portfolio causes them to perform worse than many comparable insurance companies when the equity markets fall. The next dividend aristocrat that we're going to look at is Colgate-Palmolive, which is a dental hygiene and consumer goods company with a market capitalization of $207 billion. Colgate is one of the biggest dividend aristocrats, and it also has one of the longest histories of annually increasing its dividend. Colgate's increased its dividend for 55 consecutive years, which also makes it a member of the Dividend Kings along with Cincinnati Financial. Now, Colgate operates a very defensive business model because people tend to continue buying toothpaste and the company's other products regardless of what the economy is doing. It seems ridiculous to say, the stock market's down, so I'm going to stop brushing my teeth. People just don't do that, and that impacts Colgate's financial results in a positive way. As you can see on the screen, Colgate's earnings increased by 8%, followed by a 20% increase in 2009, before dipping by an almost negligible 1% in 2010. The company's stock also performed quite well. As you can see, towards the beginning of 2009, Colgate experienced a minor drop in its stock price before rebounding quickly thereafter. If you were to buy at the worst time of this cycle and sell at the worst time, your peak to trough decline will only be about 37%, which is much better than many comparable equities. The next dividend aristocrat we'll look at is Clorox. Now, Clorox is a manufacturer and distributor of cleaning products, which is unsurprisingly most famous for its Clorox bleach. The company has a market capitalization of about $19 billion and 40 years of consecutive dividend increases. Much like Colgate, Clorox operates a very defensive business model. People don't tend to stop cleaning their homes just because the stock market is down. And you can see that impact on Clorox's financial results here. The company did not report a single year of negative earnings during the recession, and its cumulative growth during this period is very impressive, with an 18% earnings growth rate in 2009 and an 11% earnings growth rate in 2010. The company's stock followed suit, trading in a narrow band throughout the entire financial crisis. Investors who bought high and sold low here would have only lost 33% of their initial investment. Accordingly, Clorox is a great investment to own if you think a recession is around the corner, particularly if you can buy them at an attractive valuation. The next company we'll look at is Cintas, and Cintas is a specialized laundry company that is most well known for manufacturing work uniforms for large corporations. The company trades with a market cap of $17 billion and has 34 years of consecutive dividend increases. Now, Clorox's performance is one of the worst that we've seen in recent slides. The company's earnings declined by 15% in 2009 and 19% in 2010. And if you think about the underlying reasons why this happens, it's not that surprising. Corporations tend to stop buying new things when disposable income becomes tight. They're just like people in that way. So when the global financial crisis happened and corporations stopped earning as much money, they slowed down their earnings of new work uniforms, and Cintas's business slowed as a result. You can see how this affected the company's stock price here. Cintas experienced a slow and gradual decline in its stock price from early 2007 to mid-2009. Investors who bought high and sold low here experienced a 58% decline in their overall Cintas stock value. We don't view Cintas as one of the most recession-resistant dividend aristocrats. Instead, the company is kind of middle of the pack, and for investors where downside protection is the primary concern, we would recommend looking elsewhere. The next company we'll consider is energy giant Chevron, which is one of the biggest multinational oil companies with a market cap of $249 billion. Chevron has 29 years of consecutive dividend increases, which isn't the longest streak in the dividend aristocrats, but it's very impressive given the cyclicality that is inherent in the oil industry. Chevron's performance from an earnings perspective can be seen here during the Great Recession. Earnings were volatile, which tends to always be the case with energy companies, but the long-term trend here is definitely up and to the right, and the company performed better than many other dividend aristocrats whose businesses are known to be so cyclical. From a stock price perspective, Chevron actually performed very well. As you can see, the company did experience a minor decline from mid-2008 to late 2009, but Investors who bought high and sold low experienced a 45% decline in portfolio value. Now, considering that Chevron is an energy company, which is an industry that is known to be very cyclical, I actually consider this number to be quite good. The next dividend aristocrat that we're going to study is Dover Corporation. Dover is a diversified industrial manufacturing company with a market capitalization of $16 billion. The company has one of the longest dividend histories that I've ever seen, with 62 years of consecutive dividend increases. That makes Dover squarely in the middle of the Dividend Aristocrats, but also one of the longest-lived Dividend Kings. Dover's earnings experienced a significant contraction during the recession, dropping 46% in 2009 before rebounding 74% in the following year. The company's stock price also performed quite poorly. Investors who would have bought Dover at its high point in mid-2008 and sold it at its low point in mid-2009 would have experienced a significant drop of 59%, losing more than half of their investment. Based on this data, Dover is not one of the best dividend aristocrats to own if you're worried about your stocks declining in value. Next up is Ecolab. Ecolab is a cleaning products company with a market capitalization of $41 billion. The company has increased its dividend for 26 consecutive years, making it one of the newest members of the Dividend Aristocrats. Ecolab's earnings performed remarkably well during the recession. Earnings increased by 12%, followed by a 7% increase, followed by another 12% increase. This is remarkable even among the Dividend Aristocrats, and from an earnings perspective, Ecolab is one of the best performing companies during this time period. The company's stock did experience a minor decline, but that's mostly due to a change in sentiment, because we've seen that the business actually performed quite well during the period. Investors who would have bought Ecolab at the worst time, while also selling it at the lowest point, would have experienced a peak-to-trough decline of about 45%. While this is quite bad, investors would have had the opportunity to double down on this high-quality business and buy more after recognizing that the company's earnings were very strong during the time period. Next up is Consolidated Edison, which is often referred to as Con Ed. Now, Con Ed is a large regulated utility with a market capitalization of $24 billion. The company is remarkably shareholder-friendly and has increased its dividend for 44 consecutive years. However, Con Ed did experience a minor decline in earnings during the recession. The company's earnings fell 3% in 2008 before falling another 7% in 2009. With that said, earnings rebounded by 11% in 2010 and continued to grow after that. The company's stock price was also quite stable during the period. It did kind of trend downwards slightly, but this was nothing like some of the declines we've seen in other stocks. Investors who would have bought Con Ed at the worst point and sold it at its lowest point would have experienced a peak-to-trough decline of 38%. One thing that stands out here is that Con Ed's decline in stock price was very gradual. It was a slow trend from about $50 down to about $35. This would have been much more reassuring as an investor because short-term movements in stock price can be much more frightening than long-term trends, especially after you saw that the company's earnings did not decline nearly as much as its stock price did. Next up is Emerson Electric. This is an industrial manufacturing company with a market capitalization of $47 billion. Like some of the other companies we've talked about, Emerson Electric has a very, very long history of increasing its dividend, with 60 years of consecutive dividend increases. With that said, the company's earnings dropped quite a bit during the recession. In 2009, Emerson Electric's adjusted earnings per share declined by 27% from the prior year, before rebounding 15% in the year following that. As a result, the company's stock price also dropped. Investors who would have bought Emerson Electric at the worst point and sold it at its lowest point, they experienced a peak-to-trough decline of 57%. Losing more than half their value, Emerson Electric shares were not the best performers during the Great Recession among the Dividend Aristocrats. With that said, it's still a great business to own if you can buy it at an attractive valuation and hold it for the long term. The next Dividend Aristocrat that we're going to study is Federal Realty Investment Trust, which is unsurprisingly a real estate investment trust with a market capitalization of about $9 billion. The company has increased its dividend for 50 years in a row, which makes it a member of the Dividend Kings along with the Dividend Aristocrats. Now, real estate investment trusts were prone to performing very poorly during the recession because housing prices dropped like a rock. But Federal Realty actually performed really well. Earnings rose by 7% in 2008 before remaining relatively flat over the next 2 years. Still, the company's stock price was punished. And I think that's largely because it was lumped in with all of the other real estate trusts as victims of the Great Recession. Investors who would have bought Federal Realty at its highest point and selling at its lowest point would have experienced a peak to trough decline of about 60%. Now that hurts, but it's encouraging to see that the company's underlying performance was actually quite good. The next Dividend Aristocrat that we're going to look at is General Dynamics. General Dynamics is an aerospace and defense firm with a market capitalization of about $62 billion. The company's increased its dividend for 25 years in a row, making it one of the newest Dividend Aristocrats. General Dynamics performed very well during the recession from an earnings perspective. Earnings increased by 20% in 2008, rising another 1% in 2009, before jumping 10% in 2010. Despite this, the company's stock actually dropped like a rock during a very short period of time. And I'm actually unsure what would have really caused this. It may have been that there was some political instability about the future of the defense industry. But in any case, investors who would have bought at the high point and sold at the low point, which is a very short period of time if you look here, would have experienced a peak to trough decline of 62%. General Dynamics wasn't the best performing Dividend Aristocrat during the recession, but I think the company's underlying business will continue to perform reasonably well during future recessions. Now, with that said, General Dynamics is really overvalued right now in January of 2018. So if the equity markets fall, General Dynamics is likely to fall a lot as well. The next Dividend Aristocrat we're going to look at is Genuine Parts Company. Now, this is an automotive parts company that many of you probably haven't heard of, but that's because they're most well known for their brand name Napa Auto Parts. Genuine Parts has a market capitalization of $15 billion and has increased its dividend for 61 years in a row. As you can see here, Genuine Parts experienced a 2% decline in earnings in 2008 and a 14% decline in earnings in 2009. Earnings rebounded by 20% in 2010, but the company still experienced 2 consecutive years of declining earnings. And if you think about the fundamental reasons that probably caused that, I imagine that consumers tend to put off unimportant, or I guess not unimportant, but non-urgent automotive repairs during the Great Recession because disposable income for the average consumer became much more constrained. As you can see with Genuine Parts stock price, it also declined fairly significantly, losing 51% of its value for investors who bought at the top and sold at the bottom. The next company we'll look at is W.W. Grainger. W.W. Grainger is a business-to-business distributor of maintenance, repair, and operating supplies with a market capitalization of $13 billion. The company's increased its dividend for 46 consecutive years, which puts it on pace to join the Dividend Kings database in 2022. As you can see here, Grainger experienced a minor 14% decline in earnings during 2009, but if you look back further, they still earned more in 2009 than they did in 2007. This is primarily due to their strong 23% earnings growth in 2008, and all things considered, I think the company performed quite well during the recession. Its stock was also reasonably stable. Investors who would have bought at the highest point and sold at the lowest point would have only lost 41% of their value in W.W. Grainger stock. Next up is Hormel Foods Corporation. Hormel Foods is a packaged food company that's most well known for its signature Spam product and Jennie-O turkey. Hormel has a market capitalization of $18 billion and has increased its dividend for 52 consecutive years. On this slide, we can see Hormel's fundamental performance during the Great Recession. Earnings dropped by 4% during 2008, but followed up that minor decline in earnings by 2 significant 21% growth years in 2009 and 2010. Now, with those things considered, Hormel performed very well during the recession, and I would view this company as one of the more recession-resistant members of the Dividend Aristocrats list. Here we can see the company's stock price performance. Between early 2008 and late 2008, Hormel did lose a significant portion of its value, but the most unlucky investors would have only lost 41% here, while earnings continued to grow. So all things considered, Hormel performed quite well during the Great Recession. Next up, we have Illinois Tool Works, which is an industrial manufacturing firm with a market capitalization of $59 billion. This company has increased its dividend for 54 years in a row, which shows that it has the capability to be profitable under all economic cycles. ITW's earnings declined by 9% in 2008 and 37% in 2009, before rebounding by an amazing 57% in 2010. The company's 2 consecutive years of declining earnings were likely to be very worrisome for its investors at the time. Now, with that said, you can see what happened to the company's stock price. It declined by even more than its earnings. investors who would have bought at the high point here and sold at the low point would have lost 56% of their value, which would have been a troubling occurrence indeed. The next dividend aristocrat that we're going to look at is Johnson & Johnson, which is the world's largest healthcare company and one of the most stable businesses around. Johnson & Johnson has a market capitalization of $396 billion and has increased its annual dividend payment for 55 years in a row. On this slide, you can see Johnson & Johnson's earnings during the Great Recession. Earnings increased by 10% during 2008, 1% during 2009, and 3% during 2010. Looking further back, Johnson & Johnson has a streak of adjusted earnings per share growth that lasts more than 30 years. That really shows the stability of this company's business model. Here we can see the company's stock price performance during the Great Recession. While Johnson & Johnson did record a minor decline in its stock price, investors who bought at the top and sold at the bottom would have only registered a 36% loss in their portfolio value. Next up is Kimberly-Clark, which is a tissue and personal care company with a market capitalization of $41 billion. Kimberly-Clark has increased its annual dividend payment for 45 years in a row. They're one of the most stable businesses around, just like Johnson & Johnson. Here we can see the company's earnings per share performance during the Great Recession. Earnings dropped by a minor 4% during 2008, before increasing 11% in 2009 and dropping 2% in 2010. From a stock price perspective, Kimberly-Clark recorded a slow and steady decline in its stock price from early 2007 until early 2009, before rebounding relatively quickly after that. Investors who bought at the top here and sold at the bottom would have only registered a 40% decline in their portfolio value. Even better, Kimberly-Clark's stock price movements were very steady, so there was no surprises from this consumer goods giant. Next up is Coca-Cola, the world's largest beverage company. Coca-Cola is a company that really needs no explanation, but many people are surprised to see how large it is. The company's market cap is $201 billion, and Coke has increased its dividend for 55 years in a row. Here's the company's earnings per share performance during the recession. Earnings increased by 17% during 2008, fell by 3% during 2009, and increased by 19% during 2010. All things considered, Coca-Cola's performance during the Great Recession was actually quite good. Here's Coca-Cola's stock price performance during the same time period. As you can see, Coke's stock price rose steadily from early 2007 until early 2008, before dropping from early 2008 to early 2009. From then, the company's stock price increased at a normal rate. Investors who would have bought at the top and sold at the bottom here would have realized a 42% decline from peak to trough. Now, with that said, the company's bottom point during the Great Recession is only slightly lower than its point 2 years before that. So, Coca-Cola will remain one of the more stable businesses during this tumultuous time period. Next up in our study of the Dividend Aristocrats is Leggett Platt. This is a diversified manufacturing company with a market capitalization of about $6 billion. Leggett Platt has increased its dividend for 46 years in a row. So while this isn't the largest dividend aristocrat, it is one of the dividend aristocrats with the longest dividend histories. Here we can see the company's earnings per share performance during the recession. On a fundamental basis, using earnings as a benchmark, Leggett Platt was one of the worst performing dividend aristocrats. Earnings per share decreased by 82% during 2007, although Leggett Platt did manage to remain profitable and it continued to increase its dividend. From then, earnings increased by 161% in 2008, 1% in 2009, and 55% in 2010. While those percent numbers seem quite impressive, the company's earnings took many years to recover to its pre-crisis highs. Here's Leggett Platt's stock price performance during the Great Recession. As you can see, the company was trading at nearly $25, although it dropped to almost $10 by the end of the recession. For investors who bought at the highest point and sold at the lowest point, they would have registered a 59% decline in their portfolio investment. Now that is significant, but it's interesting to see that Leggett Platt is one of the few dividend aristocrats whose stock price actually declined less than its earnings during the Great Recession. In the future, I would expect Leggett Platt's earnings to drop like a rock if economic activity slows down, but it looks like its stock price should perform better than its earnings moving forward. Now, the next dividend aristocrat we're going to discuss is Lowe's. Lowe's is a leading home improvement retailer with a market capitalization of $87 billion. The company has increased its dividend for 55 years in a row, which makes it not just a dividend aristocrat, but also a dividend king. On this slide, you can see the company's earnings per share performance during the recession. Lowe's experienced a 20% decline in earnings in 2008, a 19% decline in 2009, before 2 years of strong rebounds, 19% in 2010 and 17% in 2011. Here we can see the company's stock price during the time period. Lowe's experienced a slow and steady decline in its stock price from early 2007 to early 2009. Investors who bought at the top and sold at the bottom would have lost 62% of their original investment. With that said, Lowe's stock price climbed much more than its earnings, which would have provided a buying opportunity for investors that could see this opportunity. Next up is McDonald's. Now, McDonald's really stands out even among the Dividend Aristocrats for being one of the most recession-resistant businesses that I've ever studied. Now, this is primarily attributed to its really low prices. People tend to buy more McDonald's during recessions because it's just so affordable. They also benefit from their scale, including more than 36,000 locations and a market capitalization of $143 billion. McDonald's dividend history is also quite impressive. The company has increased its dividend each year for 41 consecutive years. Here we can see McDonald's earnings per share performance during the recession. McDonald's increased its earnings by 26%, 8%, and 16% during the Great Recession, a time period when many more complicated and leveraged businesses were going out of business completely. The company's stock price also really stands out. While we can still calculate a peak to trough decline here, but I personally don't think that it's that meaningful because as you can see from the image, the trend for McDonald's stock price was still up and to the right during the recession. With that said, investors who would have somehow bought at the worst point here and sold at the worst point would have experienced a peak to trough decline of 35%. Next up is Medtronic, a medical device company with a market capitalization of $118 billion. Medtronic has increased its dividend each year for 40 consecutive years and also performed very well during the global financial crisis. The company grew its earnings by 12% in 2008, 10% in 2009, and 5% in 2010, which shows the recession's resiliency of its business model. Next up, we can see the company's stock price. As you can see, Medtronic's stock actually was performing quite well until it experienced a significant drop in mid-2008. For investors who bought at the top and sold at the bottom, they would have lost more than 50% of their original investment. With that said, Medtronic's earnings continued to grow, so this would have just been a buying opportunity for the opportunistic investor. The next Dividend Aristocrat that we'll study is McCormick, which is perhaps the most recession-resistant among the Dividend Aristocrats. McCormick is the world's largest spices and seasonings company, with a market capitalization of $13 billion. The company has increased its dividend for 31 years in a row and performed very well during the Great Recession. As you can see here, McCormick increased its earnings by 11% in 2008, 9% in 2009, and 13% in 2010. The company's stock price performed slightly worse than its earnings, but it was still one of the more stable businesses among the Dividend Aristocrats during the Great Recession. Investors who bought at the top and sold at the bottom lost just over 30% of their overall investment, less than a third. Now, 33% loss sounds like a lot, but relative to other equities and even the other Dividend Aristocrats, this performance is very strong. The next Dividend Aristocrat we'll study is the 3M Company, which is a diversified industrial manufacturer that manufactures more than 60,000 products and trades with a market capitalization of $148 billion. 3M has increased its dividend for 59 years in a row, which makes it a Dividend King as well as a Dividend Aristocrat. Here we can see 3M's earnings performance during the Great Recession. Earnings declined by 13% in 2008 and 8% during 2009, before rebounding by 27% in 2010. The company's earnings did decline, and so did its stock price. As you can see here, the company experienced a slow and steady decline in stock price from mid-2007 until early 2009. For investors who bought at the top and sold at the bottom, this represents a peak-to-trough decline of 56%. The next Dividend Aristocrat that we'll discuss is Nucor Corporation, which is a steel company with a market capitalization of $22 billion. Nucor, despite operating in the volatile steel industry, has actually increased its dividend for 44 consecutive years. On this slide, we can see the company's earnings performance. Earnings fell by 13% in 2008, 8% in 2009, before rebounding by 27% in 2010 and dropping by 57% in 2011. Now, Nucor's performance here tends to lag the overall economy, and that is probably due to fluctuations in steel prices not perfectly lining up with fluctuations in the business cycle. As we can see on the next page, though, the markets relentlessly punish Nucor's stock simply because it operates in the steel industry. Investors who bought the peak and sold the trough here would have experienced a loss of 69%. Accordingly, we view Nucor as one of the worst dividend aristocrats to own if you're worried about a recession in the imminent future. Next up, we have PepsiCo. Pepsi is a business that really needs no explanation for most investors. They're a snacks and beverage company with a market capitalization of $171 billion. Pepsi has increased its dividend each year for 45 years, which puts it on pace to become a Dividend King in 2023. Here we can see Pepsi's earnings per share performance during the Great Recession. Earnings declined by 4% in 2008, before rebounding by 17% in 2009 and 4% in 2010. In fact, in 2009, earnings were actually higher than they were in 2007. Overall, the company's fundamental performance was quite good, and we view it as a very conservative investment opportunity for dividend investors. On this slide, we can see the company's Great Recession performance. Pepsi's stock was performing quite well until mid-2008, when it experienced this significant drop, which almost shows as a straight line on this graph. For investors who bought at the top and sold at the bottom in Pepsi during the Great Recession, they would have experienced a peak-to-trough decline of 42%. Next up is consumer goods giant Procter Gamble, which, like Pepsi, is a business that needs no explanation for most people. Procter Gamble manufactures a wide number of brands, including Charmin, Tide, Bounty, and many others, as you can see on the screen. The company has a market capitalization of $231 billion and has raised its dividend for a remarkable 61 years in a row. Here you can see the company's performance during the Great Recession. Procter & Gamble's earnings jumped by 20% in 2008 before falling by a minor 2% in 2009 and sold it at its lowest price during the Great Recession. That investor would have realized a loss of 41%, which is far better than many other equities. The next dividend aristocrat that we'll discuss is Pentair, which is an Ireland-based industrial company with a market capitalization of $13 billion. Pentair has hiked its dividend for 41 straight years, which shows that it's capable of prospering regardless of what the overall economy is doing. On this slide, we can see Pentair's earnings per share performance during the Great Recession. Earnings increased by 6% in 2008, but fell by 33% in 2009 before rebounding by 36% in 2010. The company's stock price also performed reasonably well. Pentair's stock was humming along until about mid-2008 when it dropped along with the broader equity market. Investors who bought Pentair at its highest price and sold Pentair at its lowest price would have realized a peak-to-trough decline of about 55%. Pentair kind of ranks middle of the pack when it comes to the Dividend Aristocrats recession performance, but if you can buy the company at a solid price, we still view it as an attractive investment opportunity. The next dividend aristocrat that we're going to study is PPG Industries, which is one of the world's largest paints and coatings company with a market capitalization of $30 billion. PPG has increased its dividend for 45 years in a row. Here we can see the company's performance during the Great Recession. Earnings fell by 35% in 2008 before falling by another 37% in 2009. Eventually, in 2011, the company's earnings rebounded to a new post-crisis high. And I think the broad conceptual reason why PPG performed so poorly during the recession is because people tend to just not paint as much stuff when their money becomes tight. They'll leave that paint job for next year or the year after that instead of doing it immediately. And you can see the effect on PPG's earnings here. Here we can see the company's stock price performance. Based on its poor earnings trend, PPG's stock price declined by 65% peak to trough during the Great Recession. With all this in mind, we don't view the paintings and coatings industry as one of the more recession sectors of the stock market for people who are worried about downside protection. With that said, PPG and its counterpart Sherwin-Williams, which we'll discuss later, are both great investment opportunities if you can buy them at attractive valuations. And, as I just alluded to, here's PPG's main competitor, Sherwin-Williams, which is another paints and coatings company with a market capitalization of $40 billion. Sherwin-Williams has increased its dividend for 38 years in a row, and it actually performed quite a bit better than PPG during the recession. Earnings fell by 15% during 2008 and 6% in 2009, before growing by 11% in 2010 and falling by 2% in 2011. Here's the company's stock price trend during the period. As you can see, the company's stock was generally quite stable and traded in a narrow band throughout the time period. Investors who bought Sherwin-Williams at the worst point and sold it at its lowest point experienced a peak-to-trough decline of 41%. Next up is financial information and analytics provider S&P Global, which trades with a market capitalization of $46 billion and has increased its dividend for 44 consecutive years. Here we can see S&P's fundamental earnings performance during the Great Recession. In 2008, earnings fell by 15% before falling by another 7% in 2009. Earnings rebounded by 14% in 2010, but did not reach a new post-crisis high. Now, I think the reason for S&P's poor financial performance is that people tend to just cut costs wherever possible during recessions, and financial information is an area of the business world that is particularly prone to that. Here we can see the company's stock price. As you can see, the performance is actually quite bad. Investors who bought at the peak and sold at the trough experienced a 76% decline in value. Now, S&P Global's stock price performed far worse than its actual underlying business did during the recession. And I think the reason why that is because the company operates in the financial sector. So it was punished just as much as many of the banks who had toxic loan books. I think that overgeneralization actually presented a buying opportunity. And I would expect S&P Global to perform better in future recessions where the focus is not so much on financial stocks. Next up is hardware and tool manufacturer Stanley Black & Decker, a Dividend Aristocrat with $27 billion of market capitalization and a 50-year streak of steadily increasing its dividend. The company's fundamental performance during the recession is kind of what you would expect from some company that manufactures tools. Earnings declined noticeably because people decided to use their old tools instead of buying new ones wherever possible. In 2008, earnings fell by 15% before falling by another 20% in 2009. Earnings rebounded by 46% in 2010, but did not reach a new post-crisis high. Here we can see Stanley Black & Decker's stock price performance. The trend was negative here, but it kind of makes sense in relation to the company's fundamental performance. If you bought at the top and sold at the bottom, you would have realized a peak-to-trough decline of 64% here. The next Dividend Aristocrat that we're going to study is food distribution company Sysco, which has a market capitalization of $33 billion and 47 years of consecutive dividend increases. Sysco performed quite well during the recession. The company's earnings grew by 13% in 2008, before noting a minor 2% decline in 2009 and rising another 12% in 2010. From a stock price perspective, though, Sysco did not perform quite as well. Investors who bought at the most inopportune times had the chance to realize a 47% drop on their investment. Accordingly, recessions represent a really good time to buy Sysco because the company's stock price falls by much more than its earnings do. Next up is AT&T, one of the largest telecommunications companies in the world with a market capitalization of $228 billion. AT&T has increased its dividend each year for 33 years in a row. As you can see, though, the company's size does not mean it's necessarily that stable during recessions. AT&T's earnings fell by 22% in 2008, before falling by another 2% in 2009 and rebounding by 8% in 2010. Now, the reasoning here is just logical. People tend to cut costs wherever possible during recessions, which for telecommunications companies means less satellite, less phone bills, and less additional features that people don't really need. AT&T's stock price performed quite similarly. It dropped reasonably significantly, and investors who bought at the worst times while also selling at the bottom experienced a 49% loss on their investment. Next up is Target Corporation, which is the second largest retailer in the United States behind fellow Dividend Aristocrat Walmart. We'll talk about Walmart later. Target has increased its dividend each year for more than 45 years and is on pace to become a Dividend King in 2022. Here we can see Target's earnings per share performance during the recession. Earnings fell by 14% in 2008 before rising by 15% in 2009 and 18% in 2010. Interestingly, Target performed much worse than its main competitor Walmart did during the recession, and that's probably due to Walmart's slightly lower prices. Here we can see the company's stock price performance during the period. Target's stock price fell from $70 to $30 during the recession, and investors who bought at the worst times would have lost 64% of their original investment. Next up is a company that performed very poorly during the recession, T. Rowe Price, which is an asset management firm with a market capitalization of $28 billion. T. Rowe Price has increased its dividend each year for 31 consecutive years, but that doesn't necessarily mean that it performs well during every recession. As we can see here, the company's earnings per share fell by 24% in 2008 and 9% in 2009, before rebounding in a big way in 2010, posting 53% growth. T. Rowe's stock price performed even worse. As you can see, in late 2008, the company dropped like a rock, and its stock price chart almost looks like a vertical line. Investors who bought and sold at the worst times during the Great Recession for T. Rowe Price would have experienced a 68% loss on their original investment. We view asset management firms like T. Rowe Price and Franklin Resources as kind of leveraged bets on the overall direction of the equity markets. Accordingly, they are terrible investments to buy if you think that a significant bear market is around the corner. Next up, we're going to talk about the Diversified Apparel Corporation, VF Corporation, which trades with a market capitalization of $32 billion and has increased its dividend each year for 44 years in a row. VF performed very well considering that it's an apparel company. In 2008, earnings increased by 3%, before posting a minor 7% decline in 2009 and significant 25% growth in 2010. From a stock price perspective, the company's stock price trotted along in a narrow trading range before dropping like a rock in late 2008 when the Great Recession really hit the equity markets. With that said, VF's strong fundamental performance means that this was just a buying opportunity for investors who saw it that way. Investors who bought VF at the worst time and sold it at its bottom would have experienced a 58% loss on their investment during the Great Recession. Next up is Walgreens Boots Alliance, a pharmaceutical retail corporation with a market capitalization of $76 billion. Walgreens has increased its dividend each year for 42 years in a row, and being a part of the healthcare industry is very recession resistant. As you can see here, the company's earnings rose by 7% before falling by 7%, before rising by another 7% during the recession. Overall, though, the long-term trend was still up and to the right, and the company's stock price performed much better than many of its peers. Investors who bought Walgreens at the top and sold at the bottom would have experienced a 55% loss on their investment during the Great Recession. The next dividend aristocrat that we'll study is Walmart, a company that needs no introduction for the vast majority of people watching this video. Walmart is the world's largest retail company with a market capitalization of $310 billion. The company has increased its annual dividend for 43 years on end and is one of the most recession-resistant businesses in our investment universe. As you can see here, Walmart's earnings increased each and every year of the global financial crisis, reporting 8% growth in 2008, 7% growth in 2009, and 11% growth in 2010. The company's stock price was also generally unchanged, even though the broader equity markets were in overall turmoil. Investors who bought Walmart at its high point and sold the company's stock at its lowest point would have only experienced a loss of 33%, far better than most of the other dividend aristocrats, and certainly equities that are not a part of the dividend aristocrats. Next up, we'll discuss the last dividend aristocrat that we'll be talking about as a part of this video, ExxonMobil, the world's largest energy company. Exxon trades with a market capitalization of $369 billion and has increased its annual dividend for 35 years on end. Here we can see the company's fundamental performance during the Great Recession. Earnings increased by 19% in 2008, before falling by 54% in 2009 and rising by another 56% in 2010. While earnings were lumpy here, Exxon did manage to remain profitable and continue to increase its dividend each and every year. Here we can see Exxon's stock price performance. The company actually performed really well considering it's part of the cyclical energy industry. Investors who bought at the top and sold at the bottom would have only lost 34% of their investment, which makes Exxon one of the more recession-resistant dividend aristocrats when you measure recession resiliency by overall stock price performance. We've now talked about every dividend aristocrat in terms of their performance during past recessions. So to conclude this video, I wanted to give you a list of the 10 best dividend aristocrats to own during recessions. In order of decreasing peak to trough losses, here are the 10 best aristocrats: Consolidated Edison, Colgate-Palmolive, Johnson & Johnson, McDonald's Corporation, Becton Dickinson, ExxonMobil, Walmart Stores, Clorox, McKesson, and Abbott Labs. If you're really concerned about there being a recession around the corner, these are the 10 dividend aristocrats that you should consider the most. Thanks for watching, and we hope that you enjoyed the video.